Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine a company that didn't just change how we talk, but is now fundamentally reshaping how every business operates, from the tiniest startup to the biggest global players.
And this isn't some far-off future dream. It's happening right now.
Exactly. It's a transformation led by a name you definitely know, a company already woven into our daily lives, now aiming to redefine enterprise productivity itself.
The pace of change today is just breathtaking, really.
It is, and keeping up, getting informed quickly isn't just smart. It's absolutely essential to navigate this landscape.
Absolutely critical.
So today, we're diving deep into this pivotal company. We'll look at its strategy, its innovations, its market position. Consider this your essential guide to modern collaboration and how it affects everyone, especially you, the investor.
It's a crucial conversation for understanding the future of work.
Okay, let's pull back the curtain then. We know the name, the verb it became. But who are the masterminds actually steering this ship? Who's guiding this transformation, and what shaped their vision?
Well, at the absolute core, you have the founder and CEO, Eric Yuan. His journey is, it's practically the stuff of legend.
You hear that a lot, but what's the real story?
Born in China, he faced an incredible 8 visa rejections before finally getting to the U.S. in 1997. Persistence is an understatement.
Wow, okay.
Now, before starting this company in 2011, he wasn't just anyone. He was a corporate VP at Cisco, actually leading the engineering for WebEx.
A major player even back then.
Definitely. And here's the key insight. He left Cisco, taking 40 engineers with him, because he was profoundly frustrated with WebEx's, frankly, clunky user experience.
It was personal.
Deeply personal. His obsession wasn't just making something better. It was achieving buttery smooth video calls and intuitive interfaces. That user-centered focus right from the start set them apart.
And that led to?
It led to that monster IPO in 2019. Shares soared 72% on day one. Just a blockbuster validation. And he's still leading the charge, like with the AI Companion launched in 2023, weaving generative AI into everything.
And the accolades followed, right?
Oh, yes. Time Magazine's Business Person of the Year in 2020. Induction into the National Academy of Engineering in 2025. He also made that smart strategic move acquiring Keybase in 2020, specifically to nail down end-to-end encryption after some earlier privacy bumps.
A truly remarkable origin. But one visionary, even one like Yuan, can't run a company this size alone. Who else is critical to making this machine run?
Absolutely. The executive bench strength is really impressive. You've got Michelle Chang, who joined as CFO in 2024. She brings over 25 years of serious finance chops.
Where did she come from?
She's a real heavy hitter in tech finance. Previously CFO of Microsoft's commercial sales and partner organization, so she was managing the financials for Office and, critically, Teams.
Their biggest competitor.
Exactly. Talk about knowing the enemy's playbook. Her deep experience navigating Microsoft's incredibly complex finances makes her uniquely suited for this company's AI-driven expansion. And you can already see her impact. Her focus on disciplined capital allocation. Q1 FY 2026 operating cash flow jumped to $588 million, up 25% year over year. That's tangible results, fast.
Okay, finance covered. Who's building the brand?
That would be Kim Hammonds, the CMO, who came aboard in 2025. She's a proven marketing dynamo. Built Zio's first marketing function from scratch, drove 3 years of solid revenue growth there.
So she knows growth.
She knows growth, and she has this incredibly versatile playbook honed everywhere from agile-sized startups to giants like Deloitte. That's absolutely critical right now as they pivot from being just the video tool to this comprehensive AI-first platform. She spearheaded that big 2025 AI Companion campaign push, the one that won the Newsweek AI Impact Award.
Right, I remember seeing that.
That was her. Elevating the brand, making sure the message cuts through against the noise from Microsoft and Google, that's paramount.
And legal. In this climate, that must be crucial.
Hugely.
Yeah.
Churi McAlpine, the chief legal officer since 2024, brings 25 years of expertise from places like Intercom. Her role is pivotal, navigating the absolute minefield of AI regulations and data privacy laws. They're getting trickier by the day.
Especially after their earlier issues.
Precisely. She was instrumental in resolving that big 2020 privacy lawsuit for $86 million, making sure compliance was rock solid. Her proactive approach to governance builds immense credibility with investors, with regulators. You just can't operate without that today.
Okay, finance, marketing, legal. Who's driving the sales engine?
Graham Geddes. He leads global sales as Chief Sales and Growth Officer. His focus on hybrid work solutions has been key in driving that enterprise adoption. You saw it in the Q1 FY 2026 numbers, enterprise revenue up almost 5% to over $700 million.
So he's closing the big deals.
He and his team are. They landed a major contract with a Fortune 500 retailer in 2024, for example. That underscores his strategic importance. He's also the one pushing the company hard into those crucial upmarket segments like financial services. It's absolutely key for sustained growth beyond their initial base.
So it's a formidable team, no doubt, a real powerhouse. But you mentioned the founder, Eric Yuan, is still very involved. In tech, that founder-led magic can be powerful, but how much influence does he still really wield, and is that purely a positive?
It's unequivocally founder-led. Eric Yuan is deeply involved. Day-to-day operations, long-term strategy, he's in the thick of it. And that's actually quite rare for a public company this size, around a $25 billion market cap.
So the company's fate is still tied closely to him.
Frankly, yes. Its trajectory hinges on his singular vision and his deep technical expertise. His hands-on approach, talking to engineers, talking to customers directly, ensures they stick to that core work-happy ethos. It's not just a slogan for him.
Would you call him a business genius? The results seem to suggest it.
The evidence is compelling, certainly. Outmaneuvering giants like Cisco and Microsoft, pulling off that massive 2019 IPO, it shows remarkable strategic skill. He's definitely in the elite tier, alongside names like Nadella or Jensen Huang.
But no genius is perfect, right?
Right. The 2020 privacy scandals definitely tested his leadership. But to his credit, his swift response, that intense 90-day security overhaul, actually turned a potential disaster into a trust-building moment.
So what's the potential challenge then?
The main concern, looking ahead, is the untested succession plan, or perhaps the lack of a clearly visible one. It raises crucial questions about the company's long-term stability if he ever decides to step back. That's a key risk factor investors need to consider.
That's a really critical point. Now let's dig into motivation. Are these leaders truly focused on long-term shareholder value, or are there other incentives driving them? How aligned are their interests with yours as an investor?
That's a great question, one every investor should ask. The executive compensation structure is designed to align leadership with shareholders, though, yes, it does attract scrutiny sometimes.
How does it work? Mostly salary or?
Mostly stock. Take Eric Yuan. His total comp in FY 2025 was $12.3 million, but only $300,000 of that was base salary. $10.8 million was stock awards.
Wow, heavily weighted.
Very. Other execs averaged $68 million, again, with 70–80% of that being stock awards. This structure really incentivizes long-term value creation. These awards usually vest over 4 years, so their personal wealth is directly tied to how the company performs over time.
Do they have much skin in the game through ownership?
They do. Yuan himself holds about 4% of the shares. That's worth around $1 billion. The whole leadership team collectively owns about 6%. So yes, they have significant skin in the game. Their interests are definitely intertwined with shareholders.
And the share buybacks.
Right. The company has an active share repurchase program, about $1.2 billion remaining as of April 2025. That signals management's confidence in the stock's value and helps offset dilution from those stock awards.
But you mentioned scrutiny.
Yes. The flip side is that high stock-based compensation of 16% of operating expenses in FY 2025 does draw criticism for potentially diluting existing shareholders. It's a common complaint in tech, frankly.
How does it compare to peers? Is it excessive?
It's competitive, but not really excessive for the industry. I mean, compare it to Satya Nadella at Microsoft getting $79 million in 2024, or Cisco's Chuck Robbins at $31 million. This company's payouts are lower, reflecting its smaller scale, but they're clearly enough to attract and keep top talent.
Okay, so beyond the border mechanics, what's the actual soul of this company? What drives it? What's the philosophy, and how does that culture play out day to day?
Their mission statement really is their North Star.
Yeah.
To provide the AI-first work platform for human connection. The vision is incredibly ambitious. It's not just about video calls anymore. It's about evolving into this comprehensive collaboration ecosystem.
With AI at the center.
Exactly. Integrating AI everywhere to fundamentally boost productivity, improve customer experiences. You see it in Zoom Workplace, launched in 2023. It brings together meetings, chat, phone, whiteboards, all powered by that AI companion.
So the goal is bigger than just meetings.
Much bigger. The audacious goal is to become the very backbone of modern work and customer service.
And the culture that supports that.
It emphasizes care, community, and delivering happiness. That's straight from Yuan's philosophy about making work productive and enjoyable. And it's not just words on a wall. It shows up in perks like flexible work, wellness programs, and that relentless focus on customer-centric, easy-to-use design.
Any external validation of that culture?
Definitely. They were ranked #2 on Glassdoor's Best Places to Work list back in 2019. That shows strong employee satisfaction. And you still see it today. Check out posts on X. People frequently praise the platform's frictionless experience. That suggests the culture really does translate into the product.
Okay, but even with a strong team and culture, no journey is smooth. What are the big rocks in the road, the potential pitfalls this leadership team has to navigate?
They face several significant risks. First, Yuan's outsized influence, while a strength, creates that succession concern we talked about. There's no clear public plan B if he steps down. A 2020 SEC filing even highlighted how critical his hands-on role is in product and operations. That dependency is real.
What else?
Beyond that, attracting and retaining top talent is a constant battle. Google, Microsoft, countless startups, they're all fighting for the same engineers, the same AI experts. It's a persistent challenge.
And the external environment, legal, political.
Huge factors. The legal team, under Sri McAlpine, faces constant, intense scrutiny over AI privacy and data security. Remember those 2020 missteps? They rebuild trust, but one wrong move could shatter it again. Plus, geopolitical tensions, especially U.S.-China relations, are a significant risk.
How so?
That 2020 Tiananmen Square incident involving a former exec really highlighted the risks. They employ over 500 engineers in China. Trade restrictions, data laws, political shifts, any of that could disrupt their talent pipeline or operations significantly. It requires constant vigilance.
So, putting it all together, how does this leadership team truly stack up against the industry titans, the Microsofts, the Googles? Are they playing in the same league?
They absolutely hold their own. Yuan's founder-led agility, that bias for action, it mirrors someone like Elon Musk at Tesla with similar succession risks, maybe?
Compared to Nadella or Robbins?
Nadella at Microsoft obviously brings that incredibly broad enterprise experience, running a $3 trillion empire. Robbins at Cisco excels in that complex hardware-software integration game. This company's team, they're leaner and more focused. Michelle Chang's Microsoft background, Kim Hammond's marketing prowess, they genuinely rival the talent at Google or Microsoft. This isn't a B team.
But is there a weakness in that comparison?
Yes. If you look at the bigger picture, they lack the bench depth of larger rivals. It's not just about numbers. It's about having layers of specialized expertise. And these prolonged AI wars, where you need deep talent across multiple AI domains, that could become a potential liability down the road.
Okay, fascinating insights on the leadership. Let's pivot now from the minds shaping the company to the machine itself. How does this company actually make money? What makes its business model stand out in such a crowded, competitive space?
Well, at its core, the model is almost deceptively simple, easy to grasp. It connects people, video, voice, chat. Think of it like a digital town square, a utility for interaction.
But the tech behind it isn't simple at all.
Not at all. The cloud-native architecture, the AI integration, the global data centers, that's the complex engine under the hood, the rocket science.
Yeah.
But the genius is how all that complexity is hidden behind a user-friendly interface.
So for an investor, what's the key takeaway on the model?
Sell subscriptions, layer on value with AI and customer experience tools. Simple concept, sophisticated execution. It's like a smartphone, easy to use, but the engineering inside is cutting edge.
Beyond just the core meeting concept, what's actually in the product arsenal? What specific tools are driving this growth and future ambition?
The flagship is still the core meetings product, of course. HD video, clear voice, chat for up to 1,000 participants. It hit product market fit incredibly early, exploding from maybe 3 million daily participants in 2015 to 300 million by 2020. Just astronomical growth.
But they've moved beyond just meetings now.
Oh, significantly. The cloud-based phone system, Zoom Phone, is a huge growth driver now. 7 million paid seats by 2025. It's really taking share from traditional systems. And then you have Team Chat, Docs, Whiteboard, Clips, all catering to the needs of hybrid work.
How do these pieces fit together?
That's where Zoom Workplace comes in, launched in 2023. It unifies all these tools. And it's powered by the AI Companion, which is the real game changer.
What does the AI Companion actually do?
It transcribes meetings accurately, generates summaries, automates tasks. It makes work fundamentally more efficient. It's not just a feature, it's embedded intelligence.
And the contact center, that seems like a big move.
A pivotal move. Introduced in 2022, it takes them squarely into the customer service space, competing directly with giants like Salesforce and Zendesk. It integrates voice, video, chat, AI. They landed some strategic logo wins with big enterprises in Q4 FY 2025, showing it's gaining real traction.
Any other key acquisitions or products?
Yes, they acquired WorkVivo in 2023. that's focused on employee engagement, providing intranet-like features. It recognizes that internal communication is just as vital.
And looking forward, what's the roadmap?
Deeper AI integration is key. Think agentic AI autonomous agents handling customer service end-to-end. Also, aggressive expansion into verticals like healthcare and education. And geographically, that 2025 launch of Phone in India shows their geographic ambition.
How do they actually make money from all this?
It's primarily software subscriptions combined with a powerful freemium model. Free basic plans attract users, then premium features and enterprise tools convert them to paid plans. It's a proven funnel that's driven them to 220,000 enterprise customers by Q1 FY 2026.
In a market packed with giants, what is the actual secret sauce here? What makes this company genuinely unique and sets it apart? Why should an investor care about that?
The secret sauce is really that powerful mix of superior user experience, relentless AI innovation, and inherent scalability. They have this genuine passion for delivering happiness through frictionless communication. That's Yoan's mantra, and it's real.
How does that contrast with competitors?
Unlike Microsoft Teams, which is usually bundled with Office 365, or Cisco WebEx, often tied to hardware historically, their platform is cloud-native and standalone. That gives incredible flexibility. It integrates with everything Slack, Salesforce, you name it.
So neutrality is a key advantage.
A profound competitive edge. It appeals strongly to companies wanting to avoid vendor lock-in. Plus, their AI-first pivot is a huge differentiator. AI Companion automating notes, for example. That 2024 case study showing their contact center cut response times by 30% for a bank, that's measurable impact.
And the freemium model.
It's unique in how effectively it scales. That freemium to enterprise funnel converts free users to paid plans incredibly efficiently. This independent, user-focused, AI-driven approach is a powerful, often underestimated advantage.
Every company has a story. What's the history here? How did they get from those early days to where they are now?
It's been a whirlwind, really. Founded 2011, launched 2013 with just $6.5 million in Series B. By 2015, already 40 million users, a billion meeting minutes. Incredible early traction.
Then the IPO and the pandemic.
Right. The 2019 IPO was that blockbuster success, raising $751 million. Then 2020 hit, and the pandemic supercharged growth. Revenue jumped 326% to $2.65 billion. They became a verb overnight.
But it wasn't all smooth sailing.
No. There were key pivots. That massive security overhaul in 2020 after the privacy issues, they tackled it head on. Then the big AI-first rebrand in 2023, integrating AI Companion deeply.
What does the growth trajectory look like overall?
Phenomenal. Revenue grew from $622 million in FY 2019 to $4.65 billion in FY 2025. And critically for investors, enterprise revenue is now 60% of the mix, up from just 20% pre-IPO. It shows impressive adaptability and a smart shift towards higher value customers.
How does this global operation actually work day to day? Where are the main hubs and how do they manage the vast infrastructure needed?
Headquarters are in San Jose, California, but it's truly global. Key hubs in Amsterdam for EMEA, Singapore for APAC, significant engineering and phone support presence in India, Bangalore, Mumbai, sales in Australia too.
Do they own these facilities?
No, they lease everything. It's a strategic choice, minimizes capital expenditure, keeps them asset light, but does expose them to rent hikes.
And the core infrastructure, the servers.
That's all outsourced to cloud giants, AWS, Azure primarily. Ensures massive scalability, flexibility, but it does mean reliance on third parties. Remember those AWS outages in 2020? Briefly disrupted service.
Unlike Microsoft with Azure.
Exactly. Microsoft has that in-house advantage. This company's strength is purely in the software, the user experience, not owning data centers. Engineering, though, is in-house, over 2,000 engineers across the US, India, China. Smart geographic diversification there.
So it's a lean, software-focused approach. How does that minimal vertical integration affect their strategy and potential risks?
It's very much by design. Relying on cloud providers and third-party integrations like Slack and Salesforce keeps costs down, lets them focus intensely on software innovation. But yes, it means ceding some control.
Like the AWS outage example.
Precisely. It highlighted that dependency risk. Microsoft with Azure has an edge in full-stack control. This company's trade-off is lower cost and agility for less direct control over the underlying infrastructure. Their strength is software, not hardware or data centers.
And how do they reach all these customers worldwide? What's the distribution model?
It's a sophisticated hybrid, direct-to-consumer and enterprise sales, all supercharged by that freemium model driving initial adoption at scale. Free users get basic features, a massive top-of-funnel. Then paid plans, 1550 user often, target businesses with more features, security, scale.
Who closes the big deals?
Dedicated enterprise sales teams led by Graham Geddes. They land those crucial high-value contracts like that European telecom deal in 2024. They also have a Works With program partnering with Logitech, Infocus, etc. for hardware compatibility.
Is most revenue from direct sales then?
Actually, no. Online sales dominate. About 70% of revenue comes from self-service subscriptions. It's an incredibly scalable model supporting those 220,000 enterprise customers and millions of free users, though naturally those big upmarket sales cycles take longer.
Okay, for the individual investor thinking about stability, how reliable is this income stream? Can you count on predictable growth, or is it more volatile?
The revenue stream is highly predictable. That's a key strength. About 90% comes from subscriptions, mostly annual or multi-year contracts. FY 2025 saw $4.65 billion generated just from recurring revenue.
What provides the stability?
Those enterprise contracts mainly. Q1 FY 2026, 220,000 enterprise customers, 3,800 contributing over 100K annually, and that high-value segment grew 8.5% year over year. Plus, churn is incredibly low, 3.5% annually. That reflects really sticky customer relationships.
Any variability?
Some. Reliance on enterprise renewals means economic downturns could cause delays or pushback on deals, but multi-year contracts like that 5-year deal with the U.S. University for Workplace really exemplify the built-in stability.
But no business is immune to external shocks. What are the big storm clouds on the horizon, the major threats that could impact this company's path?
There are definitely several significant threats to watch. Technologically, rapid AI advancements are a double-edged sword. Competitors like Google or OpenAI could launch superior platforms. Generative AI lowers barriers for new entrants, too.
What about regulations?
A major and growing concern. Data privacy laws like GDPR, CCPA, plus emerging AI regulations could significantly increase compliance costs, squeezing margins. That potential 2025 EU probe into AI data usage, a definite headwind to watch.
And geopolitical risks?
Still very relevant. U.S.-China tensions remain a risk, especially with over 500 engineers in China. Trade restrictions, data localization laws, any escalation could disrupt talent or operations. That 2020 Tiananmen incident was a stark reminder.
And of course, competition.
Relentless pressure. Microsoft Teams, with its 320 million users bundled with Office, Google Meet, bundled with Workspace. They're formidable challengers. Plus, agile startups like Hopin are always targeting niches. It's a constant battle.
Given all these threats, how truly resilient is this business model? Is it built to last, or are there vulnerabilities?
The model is definitely resilient, but I wouldn't quite call it anti-fragile. It thrived during the pandemic chaos, proving its adaptability. But cloud dependency and the intense competition limit true anti-fragility.
What shows its resilience?
That 2020 security pivot, adding end-to-end encryption in just 90 days under immense pressure, was a masterclass in resilience. Stable subscription revenue, diverse customer base across education, healthcare, finance, those provide buffers.
Where is it vulnerable?
Reliance on enterprise sales makes it vulnerable to spending cuts and recessions. While AI investments position it well for long-term trends, execution risks always remain. It's robust, yes, but certainly not invulnerable.
Every great company needs a moat, something that makes it incredibly hard to replicate, protecting its market share. What's this company's special sauce, its competitive edge?
When we talk moat, it's about defensibility. This company, well, it lacks true monopolistic traits, but it holds a very strong position in video conferencing. Commands around 20% of that $30 billion unified communications market. Behind Teams at 30%, but ahead of WebEx at 15%.
What creates the barrier for others?
High barriers exist. The massive cloud infrastructure needed, the continuous costly AI development, and crucially, the brand trust they've built. It's hard for newcomers to replicate that. Interestingly, regulatory heat on big tech, like Microsoft's antitrust cases, might indirectly help by limiting competitor bundling tactics.
Beyond market share, how does sheer scale factor in? Is bigger just better?
Scale provides huge economies of scale here. With 220,000 enterprise customers, 300 million daily participants, its cloud model spreads fixed cost servers, R&D across a massive base. Lowers per user costs dramatically.
Do we see that in the margins?
Absolutely.
Well,
FY 2025 gross margin was 75%. Compare that to Cisco's 65%. That was flex scale-driven efficiency. It allows them to reinvest heavily while staying profitable. Smaller rivals like Blue Jeans just can't match that.
and network effects. Does it get stickier as more people use it, like Facebook?
It exhibits moderate network effects. Yes, as more users join, the platform's value grows. Businesses prefer it because clients, partners, colleagues are already on it. Familiarity breeds preference.
Can you quantify that stickiness?
Those 7 million phone seats, 220,000 enterprise customers. It creates a sticky ecosystem. A 2024 case study with a law firm showed they retained clients partly due to familiarity with the platform.
But not as strong as social media.
No, weaker than, say, LinkedIn. Because users on competitor platforms can still interoperate via invites. There's some fluidity.
In a world of tech giants trying to lock users in, what's this company's counter move? And once you're an enterprise customer, how hard is it really to switch?
Their counter-positioning is brilliant. The standalone AI-first platform. Unlike Teams tied to Office 365 or Meet bundled with Workspace, it integrates with everyone's Slack, Salesforce, etc.
Why does that matter?
It appeals hugely to companies avoiding vendor lock-in. They want best of breed, not just what's bundled. The contact center's AI-driven personalization, launched 2022, differentiates it from Salesforce's often pricier solutions. Users on X praise this agnostic approach.
How hard is it to leave then? What are the switching costs?
For enterprise clients, switching costs are moderate. Migrating means significant retraining, complex data migration, workflow disruptions. It's costly and time-consuming. That 2024 survey finding 60% citing familiarity as a retention factor. That highlights behavioral switching costs.
But not impossible to switch.
Not impossible, especially for free users or small businesses where costs are lower. It limits the lock-in compared to, say, deeply embedded ERP or CRM systems.
And the brand, you mentioned it became a verb. How powerful is that as a competitive advantage?
It's undeniably a powerhouse. Zoom is part of the lexicon. That brand recognition is reinforced by awards like Glassdoor's Best Place to Work, Gartner's Customer Choice. It builds trust and quality perception.
Does that translate to pricing power?
Pricing power is, I'd say, modest. Enterprise plans are around $20 a month. Competitive with Teams, $25, below Salesforce, $50. But the emotional loyalty driven by ease of use and reliability strongly supports retention. People choose it.
Beyond brand and scale, are there hidden advantages? Proprietary assets, unique processes making them exceptionally strong.
Let's look at cornered resources. Their 2,000-plus engineers, including that Strategic 500 in India, are a key asset. Plus patents on things like AI noise suppression.
Is that resource truly cornered, though?
Well, it's strong, but they face intense competition for that talent from Google, Meta. Partnerships with Intel, Logitech enhance hardware compatibility, but aren't exclusive. And cloud reliance limits hard asset advantages.
What about process power, how they do things?
That's a significant, often underrated edge. Their agile development process, rolling out features like AI Companion rapidly in 2023, is impressive. Their customer-first design focus, prioritizing low latency and intuitive UI, is hard to replicate for bigger, slower companies. People notice that X-Post calling updates insanely fast compared to WebEx says a lot.
And proprietary tech under the hood.
Yes, things like their low-latency codec, the AI Companion itself. It offered a demonstrably better experience than pre-2020 WebEx. AI features like real-time translation are closing gaps and setting standards. Patents protect key innovations.
Any risk there?
The main risk is open source AI, potentially commoditizing some tech over time. Requires constant innovation to stay ahead.
Was this company just lucky with pandemic timing, or is their execution speed a durable advantage going forward?
It's a bit of both, but execution speed is definitely a durable advantage. The 2013 launch, perfectly timed for cloud and mobile. The 2020 pandemic. A fluke, yes, but it supercharged them. The 2023 AI pivot. Again, perfectly aligned with the generative AI explosion. Timing has been consistently good.
But is the speed sustainable?
Their speed is ferocious. That 2020 security overhaul 100 features in 90 days. The 2025 India phone rollout shows incredible agility. Competitors like Cisco lag, WebEx updates take months. Their lean structure, founder leadership drives this edge. Scaling AI could test it, though.
So bottom line, how sustainable are these advantages? Can this company really maintain its moat against relentless tech evolution and giant competitors?
Short to medium term, say 3-5 years. Yes, the moat looks sustainable. Brand scale, AI momentum are strong. Neutrality and agility are durable strengths. But sustained R&D investment is non-negotiable.
What are the long-term erosion risks?
Significant risks. Microsoft's ecosystem, Google's AI firepower are persistent threats. New AI native startups could disrupt. Technological shifts, maybe metaverse collaboration. Microsoft's 2025 Teams AI upgrades with Copilot, a direct threat. Plus, regulatory crackdowns on data AI could raise costs, weakening margin advantages. It's a dynamic battlefield.
Okay, we have a good grasp of the foundations and advantages. Let's look ahead now. How does this company plan to keep climbing? What's the strategy for continued growth?
The blueprint for expansion is multifaceted. First, market penetration, upselling workplace and contact center to their huge existing customer base. We saw those 3,800 customers spending over $100 annually, up 8.5%. That shows existing clients are spending more.
What else?
Second, market development, aggressive geographic expansion. Think Zoom Phone in India, continued growth in EMEA. Third, product development, enhancing AI companion with agentic capabilities, autonomous AI agents, and launching vertical-specific solutions for healthcare education.
And diversification.
Fourth, yes, diversification. Growing WorkVivo and Contact Center is critical to reduce reliance on core video. That 2024 deal where Contact Center boosted a retailer's customer satisfaction by 25%, proof it works.
What about broader opportunities, new markets, M&A?
Huge potential. New markets in emerging economies, India, Africa, with rising digital adoption. New products like agentic AI could grab, say, 10% of the $50 billion contact center market by 2030. And strategic M&A, acquiring AI or cybersecurity startups, like they did with Keybase in 2020. WorkVivo acquisition doubled employee engagement for one client, shows M&A synergy potential.
How big is the total prize they're going after? What's the size of the market and how much can they realistically capture?
The prize is genuinely grand. The total addressable market, TAM, spans unified communications, $30 Bs, contact centers, $50, and employee engagement, $10. That's $90 billion combined in 2025.
And growing.
Projected to hit $150 billion by 2030. That's an 8% compound annual growth rate. Given their current 20% share in UC, maybe 5% in contact centers, there's massive room to grow.
And grab more.
Targeting verticals like healthcare, telemedicine, and education, virtual classrooms, could add another $20 billion to TAM. Their AI focus positions them well to potentially capture 15–20% of this total expanding TAM by 2030, up significantly from maybe 10% today. The potential is enormous.
This tech seems so versatile. Where else can we expect to see it applied, and how does that help them scale?
Its universal appeal is a huge advantage for scalability. Enterprise uses it for meetings, banks use contact center to cut call times, education relied on it for virtual classrooms, healthcare uses its dedicated solution for telehealth. Government agencies use it for secure meetings.
So it fits everywhere.
Pretty much. This versatility lets them scale broadly without fundamentally changing the core tech. Niche competitors like Teladoc challenge in specific areas, sure, but the broad applicability is a profound strength.
How resilient is their operational backbone? And how diverse is the customer base? Are they too reliant on one area?
Operationally, they're built for resilience via that multi-cloud strategy, AWS, Azure, Oracle. Diversifies provider risk, though major outages can still bite. Engineering is spread geographically, US, India, China, reducing talent concentration risk.
And customer diversity.
Very diverse base. 220,000 enterprise customers across finance, 20%, tech, 25%, education, 15%, healthcare, 10%. Geographically, 60% US revenue, but 25% EMEA, 15% AMPAC. That spread cushions sector downturns, though the US reliance is something they're working on. That UK university deal shows global reach is expanding.
How long will these products even be needed? Is this a long-term play?
Highly likely needed for 10–20 years, maybe an 80% probability. Driven by irreversible trends, hybrid work, digital transformation. AI-driven customer service ensures ongoing relevance. They weathered the 2020 surge and the 2022 slump, suggesting resilience, though deep recessions could still hurt enterprise spend.
Any long-term risks to that relevance?
Commoditization is a risk that could lower odds of dominance. But the big secular trends, remote work, AI adoption, globalization, are strong tailwinds in their favor.
So boiling it down, what are the primary engines driving future growth, and what are the biggest potential roadblocks?
Key growth drivers. First, AI innovation. AI companion adoption is already at 50% of enterprise clients. Second, enterprise expansion, upselling larger organizations. Third, global reach, penetrating emerging markets. Fourth, product diversification, contact center, and WorkVivo growth.
And the main risks?
Roadblocks ahead. Market saturation as video conferencing growth slows. Relentless competition from Microsoft and Google. Potential economic downturns reducing enterprise budgets. And rising regulatory costs for privacy and AI compliance.
Okay, let's shift to the cold, hard numbers. What do the financials actually tell us about this company's health, efficiency, and trajectory, where the rubber meets the road?
Exactly. The numbers paint a picture of a maturing, highly profitable growth company balancing profitability with strategic reinvestment. Revenue growth. FY 2025 hit $4.65 billion, up 3.3% year-over-year, driven by enterprise. Q1 FY 2026 was $1.17 billion, up 2.9%. Slower than the insane 326% pandemic spike, obviously. But this steady growth reflects that successful shift to enterprise and AI. That Fortune 500 insurer deal boosted phone adoption, fueling this.
What about profitability? Margins?
Impressive improvement. GAAP operating margin hit 20.6% in Q1 FY 2026, up from 17.8% in FY 2025. Shows strong cost discipline. Non-GAAP operating margin was even better at 39.8%, reflects strong profitability. Gross margin held at 75%, which is high for SaaS, driven by scale. Compare that to Microsoft's 35% operating margin, this company's efficiency shines, although heavy reinvestment keeps GAAP net margins around 21%.
How does it look on the Rule of 40?
Q1 FY 2026 score is 42.7%. That's 2.9% growth, plus 39.8% non-GAAP margin. Comfortably above the 40% threshold. Signals strong product market fit and balanced growth. It beats Cisco at 35%, but trails hyper-growth names like Datadog at 50%.
Return on invested capital, ROIC.
Around 15%. Calculated as $700 non-GAAP operating income over $4.07 invested capital, reflects efficient capital use. Better than Cisco's 10%, but lags Salesforce's 20%. CFO Michelle Chang's focus on share buybacks, $1 to be remaining, helps boost this.
And the balance sheet, cash and debt.
This is where they really stand out. Current ratio is 4.5. That's $7.1 billion in cash and short-term investments versus just $1.6 billion in current liabilities. Robust liquidity, huge flexibility. Debt to equity is near zero. No significant long-term debt. A true fortress balance sheet built post-IPO. Supports R&D, M&A, buybacks. Compare that to Cisco's 0.5 debt to equity. This company's cash hoard is a strategic weapon.
Free cash flows at generating cash.
Generating tons of cash. FY25 was $1.95 billion, up 21.7% year-over-year, with an incredible 41.7% margin. Q1 FY 2026 saw $588 million, up 25%. This fuels AI development. Those buybacks, $500 in FY 2025. Its cash flow growth easily outpaces WebEx's parent Cisco at 10%.
Any specific customer metrics that stand out?
Key metrics: 220,000 enterprise customers in Q1 FY 2026, 3,800 contributing over 100K annually, up 8.5%. Churn rate, super low at 3.5% annually, reflecting stickiness. Phone seats, 7 million, up 20% year-over-year, key growth driver. These highlight enterprise traction and recurring revenue strength.
How do these impressive numbers stack up against rivals like Microsoft and Cisco? Is it truly a financial powerhouse comparatively?
Financially, it's solid, but maybe not best in class everywhere. Revenue growth, 3.3%, lags hyper growth like Datadog, 25%, but matches mature Cisco, 3%. Where it really shines is efficiency. That 39.8% non-GAAP operating margin tops both Microsoft 35% and Cisco 28%. Remarkable. ROIC 15%, beats Cisco but trails Salesforce. But the standout, that zero debt balance sheet. Stark contrast to Cisco's $30 B debt. And churn is 3 to 5%, is lower than Salesforce 8%, signaling stronger customer loyalty. So highly efficient, very strong balance sheet, loyal customers.
What story do these financial trends tell us overall? Still a hyper-growth rocket, or has it matured into something else?
The story is clearly one of maturation. Revenue growth slowed dramatically from the 326% peak FY 2021 to 3.3% FY 2025. Pandemic tailwinds faded, but the enterprise focus stabilized it. Operating margins steadily rose from 10% FY 2020 to 20.6%. Q1 FY 2026 shows discipline. Free cash flow grew 20% annually since FY 2022, fueling reinvestment. Enterprise customers grew 10% annually. High-value clients doubled since 2020.
So the implication is?
It's maturing, with profitability offsetting slower growth. But the big AI and contact center bets could reignite revenue if they execute well. It's not the pandemic rocket anymore, but evolving gracefully into a highly profitable, expanding enterprise player with exciting new growth levers.
Okay, the ultimate question for you, the individual investor listening. With all this data, what's the company actually worth? Is it a bargain right now, or are we looking at a premium price?
This is where analysis meets action. The concept of margin of safety is absolutely crucial. Buying below intrinsic value cushions you against errors or market swings. For this company, estimating its true worth versus the current price around $80 a share as of June 2025 is key.
How much margin is enough?
Typically, a 20–30% discount provides that buffer, critical in tech's volatile world.
Why does nailing the valuation matter so much here?
Valuation separates speculation from investing. Overpay, and you risk losses if growth stalls. Find a bargain, you can get outsized returns. It guides your buy, hold, sell decisions based on fundamentals, not hype. Without it, you're just guessing.
What tools do you use to figure out that intrinsic value?
My go-to is intrinsic valuation. using a discounted cash flow or DCF model. We project free cash flow out 10 years, discounted back at an 8% cost to capital, WACC. Assuming 5% FCF growth off FY 2025's $1.95 billion, a 3% terminal rate, 310 million shares. Intrinsic value comes out around $90 per share. It's the best method for capturing cash flow strength and growth potential.
What about comparing it to peers, relative valuation?
We look at that too. PE is 24x based on FY 2025 EPS. That's below Microsoft, 35x, above Cisco, 18x. EV/EBITDA is 15x, in line with SaaS peers. Price to sales is 5x, suggesting fairly valued relative to, say, Datadog at 10x. So not dirt cheap on relative metrics, but not crazy expensive either.
When we weigh all this evidence, what are the strongest arguments for investing right now? The bull case. And the strongest arguments against it, the bear case. Let's hear both sides.
Okay, let's steelman the bear thesis first. Institutional analysts 48 cover point to slowing growth, 3.3%, 20% for Datadog, and that fierce competition from Microsoft Google bundles. Morningstar specifically noted the phone product's complex sales cycle risks stalling upmarket moves. High stock-based comp, 16% of expenses, diluting shareholders is another common critique.
What about retail sentiment on the bear side?
On X, you see bears lamenting the post-pandemic hangover. And TechTrader123 called it overhyped, predicting margin pressure from AI costs. Others worry about commoditization from free alternatives like Google Meet. Bears basically see it as a one-hit wonder getting squeezed, unable to scale AI fast enough. They might see the stock falling to $60 if growth stalls.
All right, now the bull thesis. What's the optimistic view?
Bulls, including institutional analysts, praise that 41.7% SCF margin and the fortress zero debt balance sheet. Goldman Sachs sees contact center doubling revenue contribution by 2030, a huge growth driver. That 20% operating margin expansion signals strong discipline.
And retail bulls.
Very vocal on X, at Investing AI hypes AI Companion as a game changer for customer service, citing huge productivity gains like cuts meeting prep by 50%. At Value122 loves the $1 2B buyback as a sign of undervaluation. To highlight the low 3% churn as proof of stickiness, bulls see it as an AI dark horse, using its brand and cash to dominate customer service. They think the stock could hit $120 if AI delivers.
So weighing both, what's the most probable outcome in your view?
I lean towards the bull case being more likely. The AI pivot, strong enterprise traction, and financial health outweigh the near-term growth concerns. Competition is real, yes, but its neutrality and agility are key differentiators. A 5-7% revenue CGR plus AI-driven contact center growth supports a $9,100 valuation fairly reasonably.
So bring it back to the current price. Discount or premium. What's the verdict for our listener right now?
At around $80 a share, it's trading at roughly a 10% discount to that $90 intrinsic value. That offers a modest margin of safety. The bull case suggests upside to $100 or more. Conclusion: it makes it a reasonable buy for patient investors looking for long-term value.
Beyond the models, what's happening right now that investors need on their radar? Headlines, chatter, upcoming events.
Recent events have been positive. Q1 FY 2026 earnings in May beat expectations on revenue and EPS. Shares popped 5%. Contact Center and WorkVivo gained traction. Then in June, the strategic phone rollout in India targeting that huge market and winning that Newsweek AI Impact Award for AI Companion adds credibility.
What's coming up?
Key events. Q2 FY 2026 earnings in August. Watch contact center growth and AI adoption metrics closely. Zoomtopia 2025 in October, their big conference. Expect new AI feature announcements. Could move sentiment. Regulatory-wise, keep an eye on the EU's 2025 AI Act. Could raise compliance costs. Monitor enterprise customer growth, AI revenue contribution, and regulatory news.
And the general market buzz. What's the narrative among individual investors online?
X posts show that mixed but cautiously optimistic sentiment. Positives. People love AI Companion's productivity boost at AI Investor 77. Cuts meeting prep by 50%.
Buybacks and low churn fuel bullishness at Value122. ZM is a cash machine.
What are the concerns being voiced?
Worries about competition at TechBear99. Teams is eating lunch in enterprises. Some flag the slow growth at Stock Skeptic. 3% revenue growth, yawn. Investors are focused on AI's revenue impact, contact center adoption, and margin expansion. The dominant narrative is cautiously bullish, seeing it as an AI contender, but wary of competition and slowing growth. Contact center potential excites, but Microsoft looms large. All right, the moment of truth. We've peeled back every layer: leadership, operations, financials, market position. Is this company truly the ultimate AI dark horse? The unexpected champion poised to dominate the future?
My view, after all this, it's a strong contender to disrupt customer service and will likely emerge as an AI winner, but maybe not the single ultimate dark horse to dominate everything. Its AI-first pivot, led by AI Companion and Contact Center, positions it to grab a solid 10–15% of that huge $50 billion contact center market by 2030. That could add $5–7 billion in revenue. Significant. But Microsoft's scale, Google's AI depth, new startups, they limit total dominance.
Why not ultimate dominance then? What holds it back?
Strengths are clear. 220,000 enterprise customers, 75% gross margin, $7.01 cash pile fuel innovation. Contact center wins prove real-world impact. Neutrality is a key edge. But weaknesses are also clear. 3.3% revenue growth lags AI leaders like Datadog, Teams, 320M users, and free meat challenge share. AI commoditization is a risk.
What's the evidence supporting this strong contender view?
Q1 FY 2026 is 4.9% enterprise growth. 7 million phone seats show momentum. X posts hype AI potential, even as bears flag competition. That Newsweek award validates the AI path. Conclusion: it will disrupt customer service, especially for mid-market, but won't monopolize it. AI is a growth engine, not a silver bullet. Investors ignoring it miss a solid bet, but it's probably not a 10x moonshot.
For you, our insightful listener, wrapping this up, what are the key asymmetric insights, the hidden truths often missed, and what are the known risks and ultimate uncertainties to keep in mind?
Okay, key truths, the underappreciated points. That low churn, 3 to 5%, signal stickiness rivaling even Salesforce, that's huge. Contact centers upmarket wins suggest faster adoption than many projects, and Yuan's hands-on engineering involvement, a hidden edge ensuring quality.
And the key risks, the known unknowns.
Microsoft's 2025 Teams AI upgrades a direct threat. EU AI regulations potentially raising costs, squeezing margins 2–3%. Economic slowdowns delaying enterprise renewals, hitting revenue. Those are things we know could happen.
Finally, the uncertainties, the unknown unknowns.
Will agentic AI commoditize customer service entirely, wrecking pricing power? Could a disruptive startup leapfrog them with a 10x better AI platform out of nowhere? Will geopolitical tensions disrupt their China engineering hub? Those are the big question marks.
So, practical takeaway for the investor.
Consider buying on dips below $75, targeting $90–100 in 12–18 months. Monitor contact center revenue quarterly, watch Zoomtopia 2025 for AI catalysts, and maybe hedge competition risk by diversifying into other AI sauce plays like Datadog.
What an incredible journey through a company truly redefining how we connect and work. Technology moves at light speed, and staying informed really is your ultimate superpower in this environment.
Absolutely. And remember, this whole conversation around AI, the future of work, it's really just heating up. This company's path shows amazing agility against giants, but the final chapter isn't written. Your critical thinking, your engagement, that's what matters most.
Keep exploring, keep questioning, and keep transforming your understanding. We're always here to help you unpack the ideas shaping our world.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.